Every 2 months, the Reserve Bank of India's Monetary Policy Committee or MPC unveils India's monetary policy, which sometimes includes actions like raising its benchmark lending rate, also called the repo rate. Repo rate is the benchmark rate at which the RBI lends to the banks. This and other measures are meant to control inflation in the larger economy. But how does RBI raising the repo rate help control inflation? Here is how. Think of the RBI's repo rate as a measure of how cheaply money can be borrowed in the Indian economy. Banks borrow from the RBI in the overnight market at the repo rate. They in turn lend to consumers in the form of home loans, consumer loans, credit cards, personal loans, and to the businesses as well in the form of term loans and working capital. Now, if the repo rate is lower, as the RBI's MPC did during the pandemic, the cost of borrowing comes down. This makes loans cheaper for borrowers. This can lead to a buying and consumption spree because of the lower cost of loan funds. This is what happened during the pandemic, which led to the RBI raising interest rates to curb inflation caused due to higher demand of goods and services. Essentially, when demand for goods and services rises without a consumer rate increase in their supply, this can cause inflation or a general increase in prices across the economy. RBI raises interest rates to tamp down on demand so that prices come under control and within its tolerable limit of 2 to 6%.